always a slide at the end of the deck that says risks. And there's always a line item there that says geopolitical risks. And exactly which risks are sort of simmering under the surface might change over time. But there's always a possibility of some sort of conflagration around the world. And typically, like often when we see a geopolitical event outside the US, the main transmission mechanism by which it starts to affect global markets is through oil, right? So we saw this particularly in Ukraine when Russia invaded, now conflict in the Middle East. And so I think that's the biggest immediate concern in terms of the impact on the US economy. And so far, markets have really been largely shrugging it off. Now, if this continues to be, a big focus and continues on for a long time, really starts to affect the supply of oil, that then will drive the price of oil up, which then will complicate matters for the Fed here at home. The other piece of it, of course, is military funding, where now we have the U.S. government helping to fund war in Ukraine and now war in Israel. And that does cost money. It is, a commitment that the U.S. has made, but will start to hurt the U.S. budget in some way at the same time when the budget is already under pressure. And we have discord in Washington. So it's sort of the layering of these risks that starts to become an issue.
I wonder to what extent the drop in yields is a reaction to the Middle East, or is it a reaction to the Fed speak that we've heard over the last couple of days?
I still think that the U.S. markets are being driven more by the Fed than by what's happening outside the U.S. The Fed has been such a focus over the last couple of years, and they've done a great job so far in being able to bring down inflation. But this last mile for them to go on inflation is still really, really important in how long interest rates remain high. And the longer interest rates remain high, the tougher it's going to be for the economy to muddle through.
All right, so Kara, let's switch gears a little bit, focus on another data point for this market to kind of digest, and that is earnings. Corporate earnings really kicking off in earnest Friday with some of the big banks. What are you looking for this quarter from corporate America?
So the big banks, it's always really helpful that they go kind of early in the earnings season because they do have a really great view kind of across the country in terms of what's happening in both the corporate sector and the consumer sector. So what we'll be looking for is particularly on the credit side. Are we starting to see evidence that companies and individuals are feeling the pinch of higher interest rates? I think the answer is yes. So the question remains, how much are they really feeling the pinch and how much should we be worried about it? Banks are going to have to start increasing credit reserves in anticipation of that, growing pinch. So I think that'll be a really helpful view of what's happening on the ground. The other piece that we're going to have to look out for are consumer shopping habits. We've started to hear little anecdotes from retailers come through that, again, consumers are starting to feel the pinch a little bit, but hearing about the on-the-ground behavior and expectations, particularly heading into the very crucial holiday shopping season, will give us a good sense of how consumers are feeling.